Hi, everyone. First of all, I would like to thank the organizers for setting up these talks that are incredibly useful for us, your market candidates. So I'm Alejandro Martinez. I'm a PhD candidate from Stanford University. And today I will be talking about my job market paper, which is joint work with Mike C., also from Stanford University, about the burden of household debt. So debt is pervasive in the United States. 8 in 10 Americans hold any type of debt. For example, many people have loans that are a consequence of big medical bills. People that go to college, many some have student loans. Credit cards are widely used, and also people have home mortgages. So debt is present in many aspects of people's lives. At the same time, there's empirical evidence showing that despite the prevalence of debt in the United States, many subjects have a behavior that correlates with suboptimal decisions and worse financial outcomes. For example, Atma and McDonald, in a very recent paper, showed that borrowers in Pakistan are willing to pay a fee so they can repay their debt even earlier, despite the fact that does not reduce their interest rates. However, despite this evidence that people in debt make suboptimal decisions, there's not a clear mechanism to explain why that will be the case. Therefore, how holding debt can impact decisions is still not well understood. And one of the reasons for that is because many behavioral theories have actually focused on trying to understand borrowing decisions, for example, showing that present bias or self-control can drive indebtedness. But however, not so much evidence not so many mechanisms have been developed to understanding how debt could affect decisions after it has been acquired. So when you think about this, like clearly debt should impact the decisions that you make. Like failing to repay your debt could have important consequences of defaulting. There's also the impact on credit scores, and also it could affect your ability to borrow in the future and therefore exacerbate liquidity constraints. So what we are trying to do here is try to figure out if it's the case that holding debt has an impact on decisions that goes above and beyond these direct effects that we are mentioning. And in particular, the mechanism that I want you to have in mind is that is the case that debt can produce behavioral biases caused by how debt is perceived by people. This is crucial given first how many people in the United States already have in debt, but also because it provides an additional channel for us to understand the suboptimal financial behavior of borrowers. So the main research question that we're going to be asking is the case that holding debt causes behavioral biases? Second, if that is the case, can these behavioral biases lead to financial losses, which we are going to denote as the burden of debt? So what we do in this paper is to provide experimental evidence of the fact that indeed there's debt bias behavior caused by holding debt. And we're going to show that this is consistent with subjects overweighting negative balances. And we're going to have a lab experiment in which we're going to have a simplified and stylized version of debt, but so that even when we strip debt of most of its consequences, it still can impact decisions. Before I jump into the design, I want to talk for just a minute about what are the main advantages, but also the limitations of a lab experiment. First, the good thing about a lab experiment is it's going to allow us to randomly assign debt to subjects, which is going to allow us to control for example, selection bias. At the same time, it's going to allow us to equalize initial differences that are caused by having debt. Almost by definition, if I give you debt, that means that you owe money to somebody. So giving debt randomly also affects your wealth. Therefore, we are going to have to also further control for the fact that debt has this associated wealth effect. At the same time, people that have debt have also the additional option to repay it, which could make the decisions more complex, which is also something that we're going to be able to equalize in the lab. So what all of this allow us is that at the cost of the fact that we're going to have a stylized and simplified version of debt that must not necessarily reflect everything outside the lab, this is intentional. So it's going to allow us to isolate the particular financial mistakes that are caused by holding debt and not by any of the other consequences that hold outside the lab. I don't have much time, so I will go through the literature very briefly, but just mention that this paper relates to the psychology and development literature that has tried to study how scarcity leads to poorer decisions, also to the literature that has shown how people that hold debt make different decisions. Some of them are optimal, others it's hard to tell. And also, it relates to the behavioral literature that has been trying to understand what are the mechanisms that could explain why so many people in the United States have such high levels of debt. So our main contribution is first showing that debt itself, even when it's not associated to financial hardship, can still cause behavioral biases after it has been acquired. So next, I will talk about experimental design. What we're going to have is that subjects own virtual accounts with different interest rates and starting balances. We are going to have that accounts that start with negative balances are going to be referred to as debt accounts. And this is what we mean by debt in our experiment. Every 2 days, accounts are going to generate points returns that participants must allocate to these accounts. Points that you allocate to an account is going to increase the balance of that account, but it's also going to impact the returns that these accounts generate. And we're going to have that subjects are going to make a total of 4 decisions over a week-long period. And we are going to pay them at the end of the experiment based on the sum of the balances that all the accounts have, in addition to the final returns that these accounts generate. So this is our main treatment. We are going to have the subjects have 4 accounts that they can allocate points to. 2 are savings accounts, 2 others are debt accounts. Each of these accounts is associated with an interest rate and a balance. And basically what this means is that in 2 days, savings 1 account is going to generate 220 points, which is 20% of the balance that it has right now. Similar, savings 2 account is going to have a different interest rate, a different balance, but the same reasoning applies. And then we're going to have subjects also have 2 debt accounts that now have a negative initial balance, and therefore the returns that these accounts generate are going to be negative. So the first decision that subjects are going to face is, here is 500 points. How do you want to allocate it across these accounts? And if subjects will only care about maximizing their returns or maximizing their payoffs, what they should do is they should allocate these 500 points to the account that has the highest interest rate, because that what provides the highest marginal return. So in this case, you will want subjects to allocate all their points to the savings 1 account because it has the highest interest rate. Therefore, we could interpret deviations from this behavior as evidence of the financial mistakes that people could be making. And basically what we're going to try, we want to isolate how many of these deviations are caused by the fact that subjects have debt accounts. This is how we're going to do it. We are going to have a control treatment that we are going to call no debt treatment, in which what we're going to do is we're going to take the 2 debt accounts and we're going to flip the sign of these accounts, and therefore now are going to be savings accounts that have a balance that is parallel to the ones they had previously. However, the issue with this is that now when you add them up, all the balances of each account, you actually have that people in the debt treatment are going to start with lower initial wealth because of this flipping of the accounts. So in order to solve this, what we're going to do is we're going to give subjects 2 additional accounts in its treatment that they still owe and generate returns, but they're not going to be able to allocate points to. So what this accomplishes is 2 things. First, it's going to make sure that the initial wealth that subjects have is comparable, is exactly the same across both conditions, but also that the initial returns that all these accounts generate together is also going to be the same. Basically, what this means is that if I take the first account and I ask what's the return that this account generates, and I do this for all of them and I add them up, it's going to give me in both cases 500. So what this accomplishes is we have 2 treatments that have the same number of actions and also the same interest rates available. At the same time, despite some subjects having these debt accounts, subjects cannot incur losses and their wealth can only grow. We also don't have any wealth effects since starting net balances are equal across treatments. And not only that, but also because we pay subjects at the end of the experiment and the interest rates do not change, they are constant, we have that there's no uncertainty. Therefore, there's a unique payoff maximizing action regardless of what risk and time preferences you have. And then the question is, do people in these two different conditions allocate points differently? So first, before Sajid made the decision, we actually want them to understand where these 500 points come from. So what we saw then is, this is the accounts that you have. You have 500 points to allocate. This is how we calculate them. And we go one by one for each account, showing them the returns they generate and how to calculate these things. And then we told them this adds to 500 points, which is the initial endowment that you have. After Sajid see that, we present them with this screen, which is where they have to make the first allocation decision. Here they have the 6 accounts they have and the 4 boxes where they have to input the allocation. We were a bit concerned that maybe one of the reasons why Sajid allocate all the points to one account is because it's just a strategy that only requires inputting one number. So even if you allocate all the points to one account, you still have to enter a number in each of them. And not only that, we also impose that Sajid have to spend at least 60 seconds in answering this question. So imagine, for example, in the first day, when I do my first allocation decision, I allocate 500 points to savings 1. So I'm maximizing my returns. That means that 2 days later, once I go back to the experiment, we're going to have that balances are going to be reflecting the decisions I did 2 days ago. That's why we have now that savings 1 has a balance that is 1,600 points. And because this balance is higher, the number of points that I'm going to be able to allocate in this decision is also going to be higher. So basically, Sajid followed this iterative procedure until 4 decisions have been made in total. In terms of the sample, we recruit 172 US residents using Amazon Enter from the main 2 treatments that we're talking today. But we have a total of 452 subjects that are also going to be in other treatments that I will not have time to talk about it today. The median subject takes slightly below 2 hours to complete all the parts of the experiment and makes on average $33, which is a relative high payment for MTER, but we did this on purpose because we wanted to ensure that we have a high retention rate. In addition, we have during the experiment several understanding questions, tests, calculations before subjects made the allocation decisions to ensure that subjects understand the setting. And not only that, but because this is a longitudinal study where subjects have to make 4 decisions, we made them go through the instructions before every decision. So by the end of the experiment, subjects have gone through the instructions a total of 4 times. In terms of our results, we're gonna look first is let's classify the subjects based on how they allocate points through the entire experiment. So what we're gonna do is we're gonna classify you as a subject that maximizes returns if in all of your 4 allocation decisions, you allocate exactly all your points to the account that has the highest interest rate. We find that when subjects have no debt accounts, 38% of the subjects allocate all their points to the account with the highest interest rate in all allocation decisions. When we compare this to the debt treatment, we find that only 13% of the subjects do so. These are 25 percentage points different, which is highly significant. However, one concern that you might have is that this measure could be a bit stringent in the sense that even if you misallocate just 1 point in the first day, you are not going to be classified as maximizing returns. So what we do next is let's focus on the very first decision that subjects make, which is how to allocate this initial 500 points. And then we're going to ask is what fraction of these 500 points you allocate to each of the accounts that you have. What we find is that in the no-debt treatment, 73% of your initial 500 points are allocated to the account that has the highest interest rate. When we compare this to the debt treatment, now we have that only 47% of the initial endowment is allocated to the highest interest account. And this drop is mainly explained by the fact that now subjects are allocating a bigger share of their endowment to the debt account that has the highest interest rate. That's debt 1 account. So therefore, what we find is that subjects with debt allocate fewer points to the highest interest account. This holds when you look at all the decisions together, but also when you look at the decisions that subjects make in the first day. And because subjects make different allocation decisions in the first day, they end up having a lower return on these initial 500 points. In particular, they have a 10% lower return in the first day. So therefore, these differences in allocation decisions translate into financial losses. So then I just show you the numbers for the first day. Now, the next thing that we're going to do is look at how subjects allocate points over the whole experiment. This is how we're going to do it. What I'm going to do is I'm going to plot how many points subjects allocate to a particular account over the entire experiment. So what this is showing is that subjects in the no debt treatment, at least almost 40% of them have allocated no points whatsoever to the account that has the second highest interest rate. Similarly, when we look at the account that has the lowest interest rate, which in one treatment is a savings account and in the other one is a debt account, we find that in the no debt treatment, more than 0.5% of the subjects have allocated no points at all. When we compare this to the debt treatment, we now see a large spike at 900 points, which is exactly the amount that completely cancels out the negative balance that the debt account has. And similarly, when we look at the other debt account, that in one treatment is a savings and in the other one is a debt, we find a very similar pattern, although not as stark. Now we find that almost 20% of the subjects completely cancel out the outstanding debt that they have in this account. This is not mechanical in the sense that we allow subjects to allocate as many points as they can to these accounts. And you see that even there's a small fraction of subjects that end up allocating even more to these accounts. But in general, we find that subjects are allocating the exact amount that completely cancels out this negative balance. So what we find is that overall, participants focus on repaying outstanding debt balances. 30% of the subjects exactly repay the high interest debt, and 70% also the low interest account. And in an end survey, we asked subjects to provide some hindsight on the decisions, and we find that at least 24% of the subjects mention following the strategy of first they want to repay their debt, and then they're going to allocate everything to the highest interest account. We think this is very interesting because it's highlighting to the idea that many subjects realize that 20% provides the highest return. However, they still decide to repay their debt first. This is consistent with subjects overweighting the debt balances.
You have about a minute to go.
Okay, fantastic. So in my last minute, there's many things that I didn't have time to cover in this 20-minute talk. In the paper, we also look at what is the impact of having higher balances, such as that cannot be fully repaid. We also give in another treatment subjects the option to redistribute the balances between the accounts and find that once we allow for that, people make even larger mistakes. And we also saw in 2 other treatments where we give subjects the opportunity to borrow, that many people are reluctant to borrow when doing so incurs a debt. So just to conclude, we find evidence of the burden of debt in financial decisions. These results are consistent with subjects overweighting their balances, and these effects are present even for people that do not have debt, but have the possibility to borrow that I did not show today. We think this is important because it provides a new mechanism that could help us understanding why some people outside the lab are making suboptimal decisions. And not only that, but if we actually take that people in debt make worse decisions because the way that debt is perceived, this could actually lead to a vicious cycle that could exacerbate indebtedness and lead to debt traps. Thank you so much for the opportunity. And if you have any comments or suggestions, feel free to reach me by email, or I will also stay at the end of the presentation. Thank you so much.